Good evening, everyone. I hope exam went well. So I'm here to discuss MCQ questions of the management accounting. So let's start discussing management accounting MCQs. At the earliest, we will try to wind it up. Okay. So the first question which came for the exam was, which of the following option is not a characteristic of management accounting? Options given were future-oriented, accounting information, compulsory accounting, as well as management-oriented. It's very easy. The option is odd one out is compulsory accounting. Second MCQ, which personnel of financial firm plays a key role in management accounting? The option given were investors, managers, suppliers, customers. Among these, investors, suppliers and customers are people who are other than engaged in the financial point of view. So the only option available for is managers. Going to the third question, it is little numerical question. So let's start discussing it. There is a company which is engaged in manufacturing for product. They have given us the production units of each products A, B, C and D, which is 1000, 1100, 1200, 1500. They have also given the machine hours which is required for each production run for each product, which are 50, 40, 30 and 40 hours respectively. They have mentioned that each production run contains 10 units. That is, 10 units are produced in one production run. Now they are mentioned that their activity pool cost, which is 2,25,000, and they are absorbed on the basis of machine hour rate. They are asking us to find out cost driver rate. Now, how to compute the cost driver rate in the given case? So, first I have written all the production units which is given the question. Similarly, machine hours required for per production run, which is available in the question. Now, what I have done is total hours, how much is required. We have calculated, which is 1000 into 50, 50,000, 1100 into 40, 44,000, and 1200 into 30, it is 36,000, and 1500 into 40, it is 60,000. Altogether, it will come to 1,90,000 hours. Now, total runs we need to also calculate. Now, how to calculate total runs? Total runs is given straight away in the question, which is 10 numbers. Next, machine hours per run. We have to compute machine hours per run, which is nothing but total hours divided by total run. So how much I will get? 1,90,000 divided by 10 rupees 10. It will 10 numbers. It will give us 19,000 hours. I will get machine hours for each production run. So how we need to understand is, for each production run, it will take 19,000 hours. Machine hours is required. Going further, overhead is given the question, which is 2,25,000. So now, what is my that is absorption rate, that is machine hour rate, or rate per cost driver? I may say it is 2,25,000 divided by 19,000. So your answer is 11.84. The right option is option B. Going further to the next MCQ, in ABC costing, an item for which the cost measurement is required is called, it's very simple. Among the option, the answer is cost object. Okay. Next, Messrs. Vishnu Limited sells two products A and B, and it is in the ratio of 3:2. Variable cost, they have given the percentage, that is VC ratio of two products are given 95% as well as 90%. If the total fixed cost for the company as a whole, it is 7,000, they are asking us to find out break-even point in value. Now this question is based on finding out the weighted contribution upon which we need to find out our break-even point. This is a case of multi-product break-even point, I can say. So let's try to solve this question. So sales mix is given, which is 3:2. Variable cost ratio, it is given 95 and 90 respectively. Then if that is true, then what is my PV ratio? 100 minus 95, it is 5, and 100 minus 90, it is 10%. So I can now find out my weighted contribution, which is nothing but sales mix into PV ratio. That is 3 into 5%, it will be 0.15. 2 into 10% will be 0.2. So my company's overall PV ratio will be 0.35. That is sum total of 0.15 plus 0.25, or effectively I can say 35%. Now, fixed cost, straight away given the question for the company as a whole, it is 7,000. Now, I can assign the fixed cost or apportion the fixed cost on the basis of this weighted contribution. So, how much it will be? Apportion fixed cost, it will be 7,000 into 0.15 divided by 0.35, which will be 3,000. Next, for B, it will be 7,000 into 0.2 divided by 0.35. We will get 4,000. So aggregate firms, it will be 7,000 only. Now what I need to do? I need to apply the breaking point formula. What is that? Fixed cost divided by contribution per unit, or I can fixed cost into PV ratio. I can see here. So here I need to apply the fixed cost divided by PV ratio formula. So this will be 3,000, which is our fixed cost, divided by respective PV ratio of the products, which is 5% here. So 3,000 divided by 5%, I will have 16,000. And for product B, it will be 4,000 divided by 10%, it will be 40,000, aggregating to rupees 1 lakh. So correct answer is what? Option A, it is 1 lakh. Moving to the next question, they are saying a company sales declined from 9 lakh to 7 lakh, causing a profit from the profit from 50,000 to 50,000 rupees loss. What is the company's PV ratio? Here is a small tricky adjustment which they have used, which we have already done in the respective class. So here what is happening means we need to find out change in profit and change in sales, because I need to apply for computing PV ratio the other formula. Normal formula is contribution divided by sales into 100, but here I need to apply what? Change in profit divided by change in sales into 100. So in period 1, the sales is 9 lakh and the profit is 50,000, whereas in period 2, it has declined from 9 lakh to 7 lakh and the profit has become loss of minus 50,000. Now I need to find out the change in sales and change in profit. Change in sales is 2 lakh, but be very careful here. The difference is 1 lakh. See, minus 50,000 to 50,000, there is a journey. So minus 50,000 to 0, there is a 50,000. Apart from that, from 0 to another 50,000, there is another 50,000. So 250,000 becomes 1 lakh. Now applying to a formula, this change in profit divided by change in sales, we will have 1 lakh divided by 2 lakh. The answer is 50%. Moving to the next MCQ, there is a company which is evaluating 2 machines for its production line. One option is available for this semi-automated machine, they can opt, or otherwise they can opt for fully automated machine. They have given us the 2 variable cost under the both the option 10 and 4 respectively, and similarly fixed cost also they are given respectively for both the options. Now they have given us the various scenarios and they are asking us to find out which one is the right answer. So in this question, this question is based on the point of indifference point. It is based on indifference point. So let us find out first the indifference point. In option 1, the fixed cost is 12,000, and in semi that is fully, it is 30,000, and the difference is 18,000. Next, variable cost, it is for semi automated option it is 10, and for fully it is 4, and the difference is 6. Now the indifference point calculation, that is change in fixed cost divided by change in variable cost, we need to calculate. So that is change in fixed cost is 18,000 divided by change in variable cost 6,000. So I will get the answer as 3,008. So which means indifference point is 3,008. So what we need to understand here is, if my indifference point is 3,000 and my actual production happens to be something less than 3,000, I will try to use the option which has lowest fixed cost. Similarly, the indifference point is 3,000, and if my actual production or the production capability is something more than 3,000, I will try to focus on choosing the option which is giving me the higher PV ratio, because I am not bothered about my break-even point. Because the reason is what? When I am seeing that okay, demand is much more unlimited and there is no restriction for me to sell, so definitely I will reach my break-even point. So I will just focus on my PV ratio, the option which gives me the higher PV ratio, that I will choose. Whereas in the other option, that is if my production capacity or my production ability or market demand is less than 3,000, so what will bother me? My break-even point will bother me. Will I reach my break-even point or not? So hence the conclusion which I have discussed here. Now, whatever I discussed now, we need to look into the 4 options. Which one is right? So if you look into the option number 1, it is saying semi-automated machine should be chosen if the accepted production is 2,500. What I said, if my indifference point is 3,000 and if your plan for production or your restriction of the production is something less than 3,000, I will focus on PV ratio. Now look into this case, which is having the lowest PV ratio, lowest fixed cost, the answer is your semi-automated option. So hence, it seems to be the first one is the correct answer. First option is the correct. Rest of the options, if you choose, the fully automated machine, it shall be chosen if expected production is less than 2500, doesn't work because their fixed cost is very high. So it will take much time to cover my breaking point. Option 3, it is saying semi-automated machine should be chosen if the expected production is more than 3500. See, higher more than 3500, I should try to use which is having higher PV ratio. And if you look into the my variable cost, it is lower. It is there in the fully automated. So my PV ratio will be higher in the fully automated machine option. Okay, last one, the choice between the machine doesn't matter if the production is 3500. So all the they are talking about indifference point. My indifference point is 3000. So rest B, C, D, all the three options are wrong. So the only option which is right is option D. Moving to the next MCQ. Which of the following is not a method of transfer pricing? Simple, skimming price method. Next, now another problem, a company's budget and actual cost they have given us. So it is based on the standard costing question. They are asking us to find out variable overall cost variance. Given details are production, budgeted production it is 6000 unit, budgeted variable overhead it is rupees 1,20,000. Standard time for 1 unit it will take 2 hours. It is supposed to take 2 hours. Actual production they are given it is 5,900 units. Actual overhead incurred is rupees 1,22,000. Actual hours work it is 11,500 hours, and they are asking to find out variable overhead cost variance. For what is the formula for finding out variable overhead cost variance? It is nothing but standard hours into standard rate minus actual hours into actual rate. Now here they have not mentioned about standard hours, so we have to compute it. For one product, I am supposed to take only 2 hours. For one product, I am supposed to take only 2 hours. 2 hours. Then actual production it has we have taken is 5,908. So 5,902 is the only supposed to be taken time, which will be 11,800 hours. Now, is the standard rate per hour given? Now, standard rate per hour is not given. So, we need to compute standard rate per hour also. How to compute that? Budgeted overhead it is given 1,20,000, and then I can find out my budgeted hours also. For one output, it will take 2 hours. So, budgeted output was 6,000. So, 6,000 into 12,000. So, 1,20,000 divided by 12,000, you get your standard rate as 10 per hour. Next, I can apply variable overhead cost variance, which is nothing but standard hours into standard rate. We have just now computed 11,800 into 10 minus. You don't need to separately calculate actual hours into actual rate when you have already been given actual overhead incurred, which is your 1,22,000. Further simplifying it, I will get 1,18,000 minus 1,22,000. If you see, the difference is what? 4,000. Now, this 4,000, is it favorable or adverse? Please analyze. My standard says you are supposed to spend only 1,80,000. You spend 1,22,000. It means what? It is adverse. So 4,000 adverse. Your option is option B. Moving to the next MCQ. There is a company which produces 500 units of output, and it takes 12 hours per unit for manufacturing it, whereas the standard time allowed was 16 hours for 1 unit. So it seems they have worked efficiently. They can take up to 16 hours, but they have taken only 12 hours. Now, if the standard rate per hour is 48 and actual rate they have taken 52, they are asking us to find out labor efficiency variance. Labor efficiency variance, when we are calculating labor efficiency variance, it should not include the price variance. So the price is not relevant here. Now let's look into the formula for labor efficiency variance. What is the formula? It is standard hour into standard rate minus actual hour into standard rate. Now we need to compute standard hours. How to compute standard hours? See here, actual output is 500 and the standard time allowed for 1 unit is 16. So for 500 units, how much it is? 500 into 16. So HS is 500 into 16. Now what about SR? SR is given, which is nothing but 48 rupees. Minus AH into SR. How many hours they have actually taken? It is 500 units into 12, which is into 500 units into 12 into standard rate. It is 48. Further simplifying it, I will get 8,000 into 48 minus 6,000 into 48. Further simplifying it, I will get 3,84,000 minus 2,88,000. Now, 3,84,000 is supposed to be, I can take up, my expenditure can go up to 3,84,000 or my efficiency can go up to 3,84,000, but I have reduced it by 2,88,000. It means what? I have performed well. So the difference, whatever is there, it is 96,000 favorable. So I have performed well. Next, dash is a budget which is continuously updated by adding a further accounting period when the earlier accounting period has expired. The answer is very simple. It is rolling budget. Going to the next MCQ. A division of a company has operating assets of 5 lakh and generates an operating income of 1 lakh. If the company's minimum required return is 15%, what is the division's residual income? So what is the formula for residual income? Residual income is nothing but operating income minus capital employed into cost of capital. Now operating income is given, it is 1 lakh, capital employed is 5 lakh, required rate is 15%. Straight away apply it. We will get the answer 1 lakh minus 75,000. 25,000 I have one extra residual income. So your option is 25,000 C. Next, which one of the following responsibility center in the organization unit whose manager is responsible for generating revenue and managing expenses related to current activity? Various options are required. Now see here, where the responsibility of both the revenue and expenditure is with one person, that is what is your profit center. So the correct option is profit center. Moving to the next MCQ. A business is deciding between 3 different investment opportunities which are A, B and C. The profitability of each option depends on the 4 possible economic situations which are recession, stability, growth and boom. How many unique payoff values will exist in the payoff table for the decision problem? So here nothing. See, we will have scenarios for 3 products and scenarios are 4. So if you look into here, 3 into 4, how much? 12. So option is 12. Next, 2 investment projects have the following situations. They are given us the expected return as well as standard deviation for the each project. Now the problem here is I can't use expected return basis or standard deviation basis here because both the products are under different case and the baseline is not same. In this scenario, we have to apply coefficient of variation. So here, that is the reason this particular MCQ is important. Why? Because they are actually trying us to know what is the use of coefficient of variance here. Now, what is asked in the question? Which project is riskier? Okay, so first we need to find out coefficient of variation. Coefficient of what is the formula for coefficient of variation? It is standard deviation divided by expected return. So for the project A, it will be 0.75, and for project B, it will be 9 divided by 10. It will be 0.9. So the correct answer here, the project which is having the higher risk will be the one which is having the higher coefficient of variation. So the answer is project B. That is option D. Okay. So that's all the MCQ we need to discuss.